Well, thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Well, over the last couple of days, we've gotten you a slew of voices on the sidelines of the JP Morgan India Investor Conference. And the top of mind for every single investor right now is what's happening to three pockets when it comes to the Indian listed space: technology, pharma, and telecom to an extent. And we got the man who tracks TMT, which is technology, media, and telecom at JP Morgan, Ankur Rudra. He joins in right now on Talking Point. Ankur, good having you. Hope all is safe with you.
Thank you, Neeraj. Pleasure to be here. Thank you for having us.
And the pleasure is ours. Thank you, Ankur. Let's start off with what you believe would be the investor approach to or investor response to pockets that you track, Ankur, because when everybody talks about the K shape of a recovery going ahead, the ones which are on the upper end of the K curve are probably the pockets that you track.
Yeah, sure. So I think let's maybe starting with technology and IT services.
Let's do that.
One of the things we've seen in the last 2 or 3 years, if not slightly longer, has been the secular megatrends around IT services and technology. Greater technology adoption, greater intensity of technology across industries, and some of the secular trends around a lot of enterprises have to do digital transformation. A lot of enterprises were adopting artificial intelligence and migrating to the cloud. So what we've absolutely seen from COVID is it's creating an acceleration point. It's creating a significant inflection point from the adoption of many of these technologies, because global enterprises cannot survive without much more cloud migration, much more artificial intelligence, and a lot more digital transformation. So all of that is definitely seeing a benefit. And I think we're seeing some of that benefiting the IT services companies as well. So that part definitely helps. On the internet side and on the telecom side, on the internet side as well, we recently conducted a survey across India with 500 plus consumers, and one of the key takeaways was COVID has clearly changed consumer adoption of internet and technologies, and across several areas we saw a marked increase in adoption, and in many cases very durable increase in adoption, because people said that they'll keep adopting areas like online video conferencing, online groceries, and many other such areas on a consistent basis. Similarly, in telecom as well, we've seen the telecom industry and the telecom infrastructure sort of helping everybody work from home on a consistent basis. And that was a feedback we even got from a telecom service. So that's another industry which benefits to an extent. And one of the things we also did a survey on was, what do consumers think about, paying higher prices? What is the ability to sort of upgrade on their broadband connection? And the answer to many of those were actually positive. So indicates that, the telecom industry is also seeing the benefit on the positive side of your K curve.
Yeah, indeed. Okay, so can I start with what we discussed the last first, and then we'll move on to IT shortly. So telecom, right? Does it? Over my experience, I've seen that consensus trades rarely work, right? And almost everybody is on the same page when it comes to the adoption of the technology and or the work from home or the digital space, all of which requires the broadband as the highway for connectivity. And almost everybody unequivocally agrees that rates are slated to move higher. Somehow, in such a narrow market like India as well, within the listed space or even within the unlisted space, frankly, how many telecom operators are there? We're not seeing everybody make merry. It almost seems a bit of a divergence here. Why is that the case, you think?
I think it's difficult to talk about specific stocks
of course,
in particular.
I don't want
but
to.
I think right. So I think if you just take a step back and look at the evolution of the industry, obviously there's been when we look at the nature of the market structure in India and the evolution of the market structure and concentration in India, and we compare that against regional peers or global peers, what's quite apparent is that we have seen the market structure consolidate quite significantly, and the market concentration in India is not very different from many of the Asian, if not global markets, and the direction of movement actually is towards a lot more concentration. However, the flip side of that has been the industry returns, which is not, which has actually gone only southwards, and partly because of the price for the tariff for etc. we've seen over the last 3 or 4 years. Now, given the extent of market repair which is possible, if one just assumes there's a bit of a mean reversion, it is not very difficult to assume with even moderate mean reversion on ARPUs, on tariffs, one can see quite meaningful revenue recovery for the sector. So that's what we agree with and we believe in. The other thing where we think that can potentially happen is the recovery on the ARPU side, especially when you look at it on an adjusted on a GDP basis or adjusted on a GDP per capita basis, does not have to be purely on tariff hikes. It can also be on a basis of consumption. So that can be another way that we can see ARPUs recover for the sector, which can help some of the leading players in the sector.
Okay. The other question is, we know that this is a capex heavy industry. Would you reckon that the mean reversion of ARPUs being that one single big tailwind, and of course higher adoption being one thing, would take care of the heavy expenditure that we are likely to see over the course of the next couple of years, including 5G adoption and therefore bidding for that? And would the business still thrive despite all of that?
Sure. So, we've seen actually quite an elevated capex across the industry in the last 3 years,
Yes.
as several large players invested in building up their 4G networks, particularly for coverage. And I think some of the industry players have called for the elevated capex to now come down, because the incremental investments will be much more on capacity, which is not that much more expensive. Also, our research suggests that because the nature of the market in telecom in India has moved from a voice market to a data market, there is an element of high economies of scale in a data world. And what we've seen across different countries, including India, so across China, Indonesia, and India, is that there are quite high economies of scale, which means that incrementally, especially if you've got a lot of scale on your side, with rising data traffic, you don't need to invest that much into building up more capacity. It can follow demand. And I think a lot of companies are investing in 4.5G tech on the path towards 5G right now, which is in many cases soft upgrades, investing in areas like Open RAN, which can potentially bring down their overall capex levels. All of that being said, probably we are still a few years away from 5G. It depends on the timing and the pricing of the auctions. It depends on getting a use case for that. We've not seen 5G being implemented with a significant use case in many other parts of the world. So I think as a result of that, probably we will not see, and we're not estimating a significant capex investment, at least for the next couple of years.
A couple of years from now. So, till maybe October 2022 or thereabouts, you don't foresee significant capex requirements for 5G?
Without putting too fine a point on it, we think that a level of capex we've seen in the last 3 years will probably come down for the next couple of years.
Okay. Interesting. Just trying to mix a couple of things out here. I know sectors are different and therefore the recommendations are usually different. But we've seen in a number of areas wherein the builders of the infrastructure don't necessarily make as much merry as people who can use that infrastructure in a much better fashion for their gain. So, and therefore my question is, would you reckon that if internet adoption is moving up, and if the telcos can make good of providing the right quality of telecom infrastructure and connectivity, then the internet-based businesses would actually really come up? I mean, we had one large listed name which has done really well in InfoEdge. I'm not asking you to get into names again. I'm just using it as an example. But we've seen the advent of platform business coming in a big way, and some of these are internet-based as well. Within your coverage universe, are you more optimistic on some of those internet-based names?
So I think over the last 3 to 4 years, we've seen a lot of fundamental improvements in the enablement of greater internet adoption in India. Be it rock bottom data prices, Indian data prices remain the cheapest in the world by several measures. If you adjust it on GDP or GDP per capita or any other measure for that matter. We've seen enablers like open rails on the UPI system, making things a lot easier. So I think we've seen a lot of catalysts already. And with about north of 650 million high-speed broadband wireless users, I think we've already seen the enablement that can happen from the telecom side. So that will continue. I don't think that will slow down. But I think the catalysts are already there, which has helped greater internet adoption in several use cases. So I think across the internet universe, of course, we've got probably very few listed companies right now, but even on the companies which are currently private, we've seen continued adoption. Companies are continuing to do rather well, and seeing their engagement metrics, their user metrics, all head northwards.
Okay. What about the third pocket, and that's information technology? Do you reckon IT is the new FMCG in terms of valuation? A lot of people are saying that let the multiples move up. What's your sense?
So I think if we just take a step back and look at the performance of the IT services industry over the long term, I think this has been one sector which has perform consistently on an earnings growth basis across multiple different periods. And I think IT services companies, given if they can negotiate technology change well, and we've seen them negotiate the technology changes around digital transformation and artificial intelligence and cloud, which have actually they're not new. That they didn't happen because of COVID. They've been happening for the last 5 years. COVID is only accelerating many of these trends. I think many companies have made themselves even more relevant with their clients, and hence, as long as the client relevance keeps going up, I think their long-term potential from a revenue and earnings perspective will remain quite strong. Comparison between two different industries, I think, is not fair because these industries have different characteristics and different things that drive valuations.
Yeah, no, okay. Let me just rephrase my question then. You would have been, as somebody who tracks IT, comfortable because of various facets, including predictability of revenues and return ratios, giving a particular set of valuation multiples to these companies. And it could differ between market sizes as well. Do you reckon that the industry could be at a point wherein you, as somebody who's recommending the space, might be comfortable giving higher valuation multiples for various reasons? If yes, then what are those reasons?
So again, I can't comment about valuation multiples and ratings, to be honest. But what I would say is, when we go through inflection points, and I think we are going through an inflection point right now, where there is an element of increasing surprise on revenues and earnings. Because if you look at the nature of the IT sector this year, from where we were in February, then we went to the depths of COVID in April and May, where the world looked a lot bleaker. And from that point onwards, we've actually seen a lot of positive surprises from a range of these companies. So we are still in a period where we are seeing companies surprise positively to an extent on revenues and earnings. And in such periods, we generally tend to see earnings multiples tend to not exactly predict how companies would do, and they might actually move either slightly too far ahead or a bit behind. But the earnings estimates are prone to change because of the surprises. And hence, if I just looks at a point in time, it may not be a fair assumption to make in terms of how over the long term how these companies will do. So I think because we've seen a re-rating in the sector to an extent, I think that is a function of expectation of improvement in growth prospects or potential for positive surprise. I think both of those could happen.
I think I was talking to Sanjay Mukim yesterday, Ankur, and he was saying that the industry or the sell side has not quite priced in the first quarter performance as an annual performance because the street was still skeptical. Are you skeptical about the industry being able to replicate what they did in quarter one? I mean, one of the companies has come out and said that they'll actually do better than their guidance too. But do you reckon that industry at large could do better?
So I think what we've seen in the first quarter was a lot of companies did much better than expected on margin side. I think on the revenue side, we'd seen, with the exception probably one or two companies, most companies saw a relatively similar track. But what was quite clear is that the first quarter will probably be the trough quarter, and we'll see companies recover from there. To that extent, this quarter I think is quite crucial to see, how companies come out of it. What is the growth momentum, both from a revenue perspective, but also equally important on the deal wins and the deal, trajectory perspective, how they are doing, which will, I think, shape the rest of the year, and especially as we go into the next financial year. So we're yet to see how a lot of that plays. I think 1Q was not good enough for us to get a sense of how the growth might recover. And I think so far in 2Q, we're getting a lot more clarity with some of the companies you mentioned, which are highlighting things now. So we'll wait for that to come out to decide.
Okay, one final question, Ankur, and that is something that a large cap IT vendor told me, which is that at least that vendor was of the belief that global clients or global MNCs would probably move towards the larger IT vendors simply because they would want multi-delivery centers, multi-speciality within the same company, and therefore large cap IT would stand to benefit in a post-COVID world. Would you second that, or would you think that Indian IT mid-sized companies as well have got the niche skills to be able to survive and flourish, if you will?
Sure. I think, to start off with, I think generally IT services has preferred scale. It remains a bit of a scale game, and with scale one gets a lot of advantages. One gets the power of stronger delivery, stronger processes, and stronger resilience, which is probably what some of the companies have been talking about. And we've heard this from a number of companies over the course of the last 5 or 6 months, where companies have highlighted that the larger companies will benefit a bit more. there is clearly an element of possibility there where larger companies do benefit because of all of these resilience factors. But at the end of the day, so far we haven't seen, at least among the reasonably sized listed companies, anybody losing out. So sort of early to say whether there is a significant shift in success. But that being said, what we've also seen that during COVID, companies, even if they are not a large cap, but even if they have got some scale and size, if they've been able to deliver well, we haven't seen an intention of enterprises choosing to move out of their key suppliers because there's a supply risk. Nobody wants to take an incremental supply risk. So to that extent, we are not seeing vendor consolidation getting accelerated in COVID as was previously expected. It might happen in the medium to long term, but not right now.
Last question, Ankur. I'm not getting into names, but within your coverage universe, would you believe that in IT at least, you would have a bullish stance on a larger number of companies vis-a-vis not having that stance?
Sure. So I think, we have been expecting even before COVID, the enterprise, secular enterprise drivers, which is the megatrends around digital transformation at scale, AI adoption, and cloud, will help these companies grow faster in the next 3 or 4 years. Of course, CY20 or FY21 estimates have come off because of COVID this year, but structurally, they only accelerate many of these trends. So to that extent, we are expecting secularly strong growth in sort of low double digit in for some of the leading companies, in this space, which are likely to do well. So, to that extent, we remain optimistic on those companies where we're seeing as they come out of COVID, many of the drivers which were already present before COVID, I think continue to help and continue to have, drive their growth going forward.
Great. Ankur Rudra, take a moment to thank you for joining us today and really appreciate your time and have a great conference.
Thank you, Neeraj.
And the pleasure was ours. And viewers, thanks for tuning into this edition of The Talking Point.